Before the Asian markets reopen and liquidity returns, silver is already sending mixed signals, and the divergence may be more important than most investors realize. On trading screens, the price appears controlled, stable, almost calm. But beneath that surface, another story is unfolding in physical demand trends, industrial contracts, exchange inventory movements, and long-term macro positioning. Silver's price is primarily discovered in leveraged futures markets, where the majority of contracts never result in physical delivery, meaning positioning and liquidity often influence short-term movement more than actual metal changing hands. When hedge funds expand short exposure, price can fall even while structural demand remains firm. Yet silver is not merely a speculative asset, it sits at a rare intersection between monetary hedge and industrial necessity. Solar expansion, electrification policies, AI-driven energy growth, and global infrastructure transitions require substantial silver input, while mining supply growth remains constrained by rising costs, political instability, and limited new discoveries. At the same time, global sovereign debt levels remain elevated, currency competition is intensifying, and long-term confidence in monetary stability quietly faces pressure. In such an environment, divergences between paper price and structural fundamentals do not last forever. Silver historically compresses during periods of positioning imbalance, and when compression resolves, volatility expands rapidly. As markets open in Asia, thin liquidity increases the probability of sharp movement. A bullish gap could force short covering and trigger momentum acceleration, revealing that positioning had become too heavily skewed to the downside. A sudden spike followed by heavy institutional selling could signal a liquidity sweep designed to reset sentiment before a larger move. Or markets may remain unusually quiet, suggesting major players are waiting for catalysts such as dollar weakness, bond yield shifts, or geopolitical escalation. The core question is not simply whether silver rises or falls on Monday, but whether the current price accurately reflects the structural stress building inside the global financial system. History shows that silver can remain undervalued or stagnant for extended periods, testing investor patience, before repricing decisively when confidence shifts. When divergence between paper narratives and physical reality widens too far, markets do not adjust gradually, they reprice with speed. Monday may prove to be routine volatility. Or it may mark the early stage of a broader adjustment. But when silver moves, it rarely does so quietly, and the investors who understand positioning, liquidity, and macro structure prepare before the breakout, not after it.